Hello everyone. In our previous video with respect to entrepreneurship, we have seen how initial public offering works, and we have discussed about a case study about Facebook, which was considered as an escape moment in IPO. How Facebook has turned its revenues and attracted the public to invest more in its company. So we now know when a company has to come up with this idea called initial public offering and how it benefits both the investors and the company to increase their net worth. Now we're going to see some potentially important keywords with respect to IPO. This is not subject concerned. If you are anywhere near commerce department in your lifetime, in your professions, in your work, anything, if you are anywhere near, not even close to working for a company in accounts department or commerce department or finance department, these keywords are very, very essential, probably for the rest of your life. Therefore, it is must to understand the concept of these keywords very clearly and remember it. So first we will start with the initial public offering. Initial public offer refers to when a company proposing to raise its resources by a public issue should first select out the type of securities. So we know that initial public offering means the company decides to go and ask for the public to invest in them. So there are various instruments. In other words, they are called securities. So there are various kinds of instruments by which a company can ask the public to raise because the issuing plainly the shares of the company will only reduce the shareholding pattern so much once too much far away that once they do some further public offerings, the company's promoters will completely lose their shareholding pattern. So to avoid that from happening, companies sometimes raise IPO as loans also. So that's called debentures. Debenture is nothing but a long-term loan. Like how we take in a loan from bank, debentures is a loan except that we acquire it from the public. So therefore the company can offer shares of the company or also debentures and also bonds, and there are so many other ways. The decision regarding the issue of shares to be made at par and a premium should be decided keeping in view with the SEBI guidelines. Actually, there are three kinds of pricing matters with respect to share issues. One is if you are selling a share that is cost rupees 10, you can sell the share for 10 rupees itself. That is called issuing shares at par. Means you are issuing the shares at the face value itself. But if the value of the share is 10 rupees only, but you are selling the share for 12 rupees or 15 rupees, it means issuing shares at premium. How could a company sell its shares for more than what it's worth? Why would people pay for an increased amount for the shares that are not worth that much? Means, like I said before, after the IPO of IRCTC, the railway company, the share value of the IRCTC has gone up 600 times, 600%, not 600%, 600 times. As in, if you bought a share worth 10 rupees, it has went up to 600 rupees. Therefore, it wouldn't hurt to buy a share for 15 rupees and sell it for 600 rupees. It's really a good deal. So sometimes when people think that it is worth to buy a share for an increased price than what it's actually worth at that time, the investors will buy shares for that price. So this only happens with respect to a good profit earning company or a company that has a very good future like Facebook, Amazon or Tesla, something like that. So these company shares people will always be ready to buy with an increased value. And also there is another kind of pricing mechanism called issuing shares at a discount. It means that if the face value of the shares are 10 rupees, you are selling it for 8 rupees. So there is a loss of 2 rupees on your behalf. Why would a company do that? Means when a company is entering into the share market for new, and when people do not know about much about the company, like we've seen about Facebook and Tesla, we know they are successful companies and they have a good future and everything, but if we don't know a new company, we will not be ready to buy the shares of the company at the first itself. So therefore, to encourage the customers to buy the shares of a company, companies used to sell their shares for a very low value than their face value. So this is called issuing shares at a discount. This was a habit once upon a time, but after the government has seen that the companies are taking advantage of this mechanism in an unethical manner, they have banned this. So companies are not allowed to sell shares at a discount anymore. The whole process of issue of shares can be divided into two parts: pre-issue activities and post-issue activities. All activities beginning with the planning of capital issues till the opening of subscription list are pre-issue activities, while also activities subsequent to opening of subscription list may be called post-issue activities. So issue is, as we know, issuing of the shares. Issuing of the shares means when the public comes to you and they ask for, I want this many amount of shares and I'm ready to pay so and so rupees. That's once they sign up to you for buying the shares, it's called issue of shares. And the people who come to ask for this much amount of shares, what they are doing is called subscribing. They are subscribing for, let us say, 10 shares or 100 shares of the particular company. So that process is called subscription. So whatever happens in the process of initial public offering up until the subscription list is called pre-issue activities, and after a company acquires that subscription list and after they start to work with it, it is called post-issue activities. So with respect to any companies, the pre-issue activities is a huge process compared to post-issue activities, because there are a lot of things to consider and take care of before opening their subscription list. So we will see the keywords and important items that we need to note in initial public offering. Compliance with SEBI regulations. Before making any issue of capital, it is to be ensured that the proposed issue complies with the provision of SEBI guidelines for disclosure and investor protection with regards to pricing of issue, promoters' contribution, lock-in period, reservation, etc. This keywords in the last line, pricing of issue, promoters' contribution, lock-in period, these are all each individually separate topics that you might learn in your higher studies when you join the UG, but I'll say what is compliance of SEBI guidelines. Though SEBI is Securities Exchange Board of India. Essentially what it means is that any security issued by any company, whether it be a government company or a private company, whether they are Indian or foreign, whether they are small or big, anything, whether they are public or private, any securities issued by any company should comply with certain rules and regulations, and that rules and regulations is enacted by the SEBI, Securities Exchange Board of India. So whenever a company tries to issue securities, whether to public or private, they must comply with the guidelines that are issued by the SEBI. So SEBI has various guidelines like regulations like LODR regulations or ICDR regulations, issue of capital and delisting regulations. So these regulations need to be followed. The difference is that when you are a private company, these regulations are a little bit free, they are a little bit liberal. But when you become a public company, when you are doing an initial public offering, there are tons of regulations that you need to follow before you issue the shares to the public. So the companies appoint a company secretary who will take care of all these regulations. He will make sure that the company that he is working for is complying with all these regulations. After then only the company can issue the shares, and after then only it will be called a legal issue. Otherwise the SEBI has the power to make the company withdraw the issue and pay back the amount that it has collected from the public. So compliance is very much important, and holding of general meeting. If it is required by the articles of association, the consent of the shareholder is to be obtained, then the meeting of shareholder will be called. So with respect to shareholders meeting, there are general meeting, there are different kinds of meeting in a company: shareholders meeting, annual general meeting, and there are different kinds of resolutions that we will take. All of this you will learn in at a later point. But articles of association is nothing but a rule book of every company. Each and every single company that is in existence will have their own rule book, and that rule book is called articles of association. So this articles of association, or AOA, will tell what are all the requirements that the company needs to follow. That might include, if a company is willing to sell its shares to the public, other investors also who are already invested in the company should also know about that, and they should give their consent for that. Okay, not every company will have the same kind of rules, but the company whose articles of association says that there should be a meeting in which the shareholders of the company should agree to such initial public offering, the company must comply with the rules. That is that's why they will conduct a general meeting. So general meeting is nothing but a meeting of all the shareholders of the company, wherein the company will ask the shareholders that if it is okay for them to issue shares to the public. And intimation to stock exchange. A copy of memorandum and articles of association of the company is to be sent to the stock exchange, where the shares are to be listed for approval. So in India, the main two stock exchanges are BSE and NSE, Bombay Stock Exchange and the National Stock Exchange, and they have different points, they have different keywords and everything. There are various companies invested that have invested in both of those. Essentially what stock exchange is means that, like I said before, stock exchange is nothing but a market, except that the people who goes to the market are investors, and the people who sell their shares in the market are companies. So companies sell their securities in the stock exchange, and people go to the stock exchange to invest in various companies. So in stock exchange there can be variety of companies. Any company that has the eligibility according to the Securities Exchange Board of India to list in stock exchange will be available, can list their company in the stock exchange. Can list means, literally means they will add their name in the stock exchange board. There will be a huge banner in the stock exchange. The companies will ask the stock exchange to add their name in the list. It's called listing process. So after adding, the company will take money from the stock exchange, whoever who has invested through stock exchange. So that's how it works. So before doing so, the company will send its rule book, that is the AOA, and a memorandum of association, which is nothing but the basic details about the company, where it is located, how many members it has, and what is the name of the company, how big the company is, and everything. So that's the memorandum of association. These two documents, along with several other documents such as the annual reports and the shareholders list, sometimes will also be sent to stock exchange, because the stock exchange needs to know that the company will comply with the regulations, and if it doesn't comply with the regulations, it needs to intimate it to the Securities Exchange Board of India about the company. So to have that details about the company, they will collect this data. And appointment, a company which issues shares has to appoint one or more merchant bankers who act as lead managers to the public issues. The company may also appoint registrars, underwriters, brokers, etc. So merchant bankers, who are merchant bankers means the company who wants to do the initial public offering will have to comply with a lot of rules and regulations, and there is a lot of process concerned with it. There could literally be a crore people investing in the company at the same time. They can invest like crores and crores of money. So to handle all that will be a tough task. It will be almost impossible for a company who is doing it for the first time. So to enable the companies who are willing to do an initial public offering, there are these merchant bankers who professionally do that. Like they do that to other companies. They provide that service. They provide the service of helping the companies to do the initial public offering. So by doing so, they reduce the workload of the companies. So those people are called merchant bankers. Merchant bankers could be any bank like SBI or HDFC or Axis Bank or anything. And there are also private institutions who are specifically allowed to be merchant bankers. And yeah, they will take care of all the company's regulations and requirements for the company. Basically, they are like a power of attorney. And the company may also appoint registrars. Registrars are now none but the one who holds the registry of all the shareholders. And underwriter is a person who is like a broker, who will make sure that the shares of the company is being sold to the public. And yeah, there are other kinds of brokers too. So these people are required for initial public offering.